second experiment was conducted actually a couple years earlier in Gujarat, and there we were interested in understanding, if this product is great, what would be the barriers to adoption? And so the project is motivated by the fact that when we introduced the product with a substantial discount, take-up was actually very low. So all insurance policies have a negative expected value. That is, you on average, you'll get paid less by the insurance company than the amount of money you pay to the insurance company. But we all buy car insurance or a homeowner's insurance because if that very bad state of the world happens, our car gets totaled or our house burns down, it's very important that we get a payout. What we did is we introduced farmers to the product, and we offered them the product with a positive expected value. So every $1 of insurance policy they bought, they would expect on average to get more than $1 paid out at the end of the term. And this, in theory, should be a very attractive product for the farmers. In one of the districts, the return was as high as 80% over a 3-month period. If you annualize that, that's all of a sudden into the hundreds of percent return. And then if you risk adjust it, it's even more attractive. Yet even when the policy was so attractive, take-up was less than 50%. And so we conducted a range of experiments to try to understand what limited demand for the insurance policy. And you could certainly hypothesize a range of things. So this is a new insurance policy for many people. They're not familiar with it. They're not familiar with a formal financial contract. They've never entered into a formal financial contract in their life. So maybe they just don't understand it. Perhaps trust is important. Perhaps liquidity is a concern. So we randomly assigned a range of treatments to try to unpack these hypotheses. So to everybody to whom we sold insurance, we provided sufficient education to explain what the product was, but we randomly assigned a fraction of households to get an additional education module which related millimeters of rainfall to the moisture in the soil. Farmers typically put their fingers into the soil to try and gauge the moisture when trying to make decisions about whether the ground is wet enough to plant, and they may not be familiar with the policy which pays based on millimeters of rainfall rather than soil moisture. So we provided an education module. That turned out to have no effect. It didn't increase take-up. We also measured the effect of salience by simply randomly selecting some households to receive a visit from our insurance sales team, while others households were invited to attend a village meeting, but would have to hunt down the sales team on their own to purchase the policy. That had a sizable impact, I think about 17%. In some sense, you could say we solved the mystery of the door-to-door insurance salesman. We were interested in the role of trust. So this is a product where you pay money and you get a promise that maybe in the future, if conditions are right, we'll come back and pay you money, and perhaps trust was a barrier to adoption. It's, of course, not entirely obvious how to manipulate trust. What we did is we had some of the sales teams accompanied by a member of the microfinance institution, Basics, that the farmers knew, and the Basics employee endorsed the sales team. They didn't say that you should buy this policy or that this is a great policy, but they said that the person selling you this is honest and what they're telling you, you can believe. That had a big impact on take-up as well by about 8 percentage points, and we see an increase in demand only from the households that knew the Basics representative. Finally, we were interested in liquidity. So this insurance is typically being sold at the beginning or just before the beginning of the growing season. This is now 6 months since farmers have received payment from their previous harvest. It's the time at which they have to make other input decisions, such as buying fertilizer, buying seeds, and possibly hiring labor, so cash could be particularly tight at this period. To manipulate liquidity, what we did is, as part of the study, we were conducting household surveys, and following a household survey, which can take up to two hours, we typically offer the respondent some small compensation or symbolic thanks for their efforts, maybe $1 or $2 in payment. What we did was we randomly varied the size of the payment. So some households got relatively large payments, I think about 100 rupees, which wasn't quite enough to buy an insurance policy, but would help get you closer to that. Other households got smaller compensation, approximately 25 rupees. We found that this had a very dramatic effect on take-up, about 40 percentage points increase in adoption, and which suggests that liquidity is a very important consideration when designing insurance policies.